Good morning, everyone. Thank you for joining us this morning for our Business Essentials. I'm Cheryl Angeles, President and CEO of the San Mateo Area Chamber of Commerce. And I want to introduce Amy Cook, who is a board member of the San Mateo Chamber, and she is going to introduce Sarah. So thanks very much. And Pauline will be muting everyone, and then towards the end, she'll open it up for questions and then close it up. So take it away, Amy.
All right, so they can just chat their questions in, right?
Yes.
Okay. So my name is Amy Cook. I am a financial advisor with Maven Lane Financial Group here in San Mateo. So we're all working virtually now, and it's good to see you guys here. I think it's great that the Chamber has been doing these business essentials meetings, and if you want to attend others, they're on the Chamber website. So Sarah Garrity, she's with BlackRock, and she's going to do a global market outlook for us today. So I will pass it over to Sarah.
All right. I'm going to share my screen. Well, thank you. Good morning. My name is Sarah Garrity. I represent BlackRock and part of our retirement insurance group covering the West Coast. I spend about 80% of the time on the road, but today I'm coming from you live from my house in Denver. But I really appreciate the invitation from Amy with Maven Lane Financial and Cheryl, so thank you. We have a lot to cover in the next 20 minutes, so I think I'm going to start with just a quick introduction of who is BlackRock. BlackRock is the world's largest global investment manager and technology provider. And our purpose is to help more and more people experience financial well-being. So we're dedicated to helping our clients, our employees, and our communities achieve financial security, financial mobility, and financial freedom. We're also very proud to call the larger Bay Area home, and we're located in downtown San Francisco. So I believe about just 22 miles away as the crow flies. So I spent a lot of time in the San Mateo area. I've logged, I think, over 20 nights last year at the San Mateo Marriott. So hopefully when things return to a sense of normalcy, we'll have a chance to meet in person, and we'd be happy to host you at our offices. So I'm going to spend the next couple, 15 minutes highlighting some of our views from the BlackRock Investment Institute. The BlackRock Investment Institute is essentially a team of experts internally at BlackRock. So our economists, our market researchers, that they really develop our investment views for our clients, and they work very closely with our portfolio managers to inform investment decisions. So it's not just the opinions of one person at BlackRock or my views on the market, but really it represents the collective perspective of what BlackRock thinks. And 2020 is certainly shaping up to be an interesting year. It's the year of the virus as the spread of COVID-19 continues to have a very dramatic impact on our lifestyles, economic activity, financial markets, and we've seen some very high volatility levels as well as some liquidity challenges. So I haven't had a chance to look at the markets this morning because I've been on calls, but futures look very good coming into today. We've seen a little bit of a decrease in volatility. And if you look at the numbers, you can see the Barclays Ag is at 4.83. S&P 500 is still negative year to date, down 12.83, but it's come up considerably from its low back in March. The MSCI EFA down 21.34, the 10-year sitting at 0.62, and perhaps most notably, you're seeing oil at $16 per barrel, which is meaning it's much better behaved since Tuesday. Still significantly below where we started the year, but a couple of things to highlight there is that the July contracts are showing $22.50 per barrel, and that curve is showing upward, really suggesting that we could normalize, but we're certainly not out of the woods yet. So let's see if this will, there we go. All right, this is probably the most important slide, and I'll spend the most time here kind of talking about what we're seeing. But the market shocks and the impact since the coronavirus have been very reminiscent to 2008 or perhaps 1987. And I think it's important to note that we don't believe that this is a financial crisis, but rather, in the words of our CEO, Larry Fink, that it's a crisis of confidence. And I'm going to start with my close and where I'm going to end, is that now is not the time to run away from the markets, and we're encouraging investors to remain level-headed and to take a longer-term approach. With that longer-term approach, I think it's important to remember in the near term to medium term that we're still expecting to see volatility and market moves. So before I talk about where we are, I think it's important to look back. Where we started, that provides the foundation of what we're seeing. And 2019 was a historic year in the markets. There's only been 4 years since 1926 that have been better for both stocks and bonds. And total return for the year was positive across all asset classes. So everything from commodities to fixed income, and most impressively equities, including both developed countries such as here in the United States and Europe, as well as emerging markets. And 2019 was certainly a year about policy. And what I mean by that is, we had some unexpected cuts by the Fed here in the United States, as well as around the globe. And that accommodative, policy and cuts from the Fed really relieved some of the trade tensions that we saw. And I'm pointing that out because the underlying health of the economy, and I think it's really important to separate, the stock market is not the economy and vice versa, right? But the underlying health of the economy coming into this looked very good. We had historic unemployment. Wages were starting to tick up, something that we hadn't seen in quite some time. And debt services, meaning household debt, was really the lowest since we started tracking it in the 80s. So really no major alarm bells or threats of a recession. So coming into the year, there were 3 things that BlackRock was looking at. We believed that growth was going to edge up around the globe, that we'd see a policy pause. By that I mean, less intervention from central banks, and kind of redefining resilience. So thinking about how to add resilience to portfolios. Now, at the start of the year, the markets were discounting the coronavirus. They saw it as a specific health challenge that was limited to China, that it certainly had global repercussions, but something that was fundamentally contained. I think it's kind of incredible. I don't know about you, but I'm having a more difficult time measuring time. It's pretty incredible to think that just 3 months ago, Tuesday, is when the Centers for Disease Control and Prevention announced the first confirmed cases of the novel corona cases in the US. And now the dimensions of the public health crisis are really a global pandemic, with the United States at the epicenter, that we really took the baton from Europe. So we really see 3 primary uncertainties as it relates to both the macro environment, so the economy, as well as the stock market itself. So the 3 things that we're watching very closely is the progress and the trajectory of the virus itself. Secondly, which is the economic impact of private and public measures to contain it. And the most important thing besides the unfortunate human toll of the virus is the actions of monetary and fiscal authorities to mitigate it. So, we've really updated, this caused us in April to update our 2020 outlook. So from growth edges up, we've moved to an activity standstill, that the coronavirus shock has been very sharp. You've essentially seen our economy, both here and globally, completely frozen, so kind of unknown territory. Secondly, coming into the year, we thought that, again, there'd be a policy pause, but now you're seeing really bold policy action, and we'll talk about this, but it's the largest peacetime response that we've ever seen. It's pretty incredible in its scope and scale. And lastly, rethinking resiliency to resiliency rules. Resiliency really has played a bigger part in portfolios and in the markets going forward. So I'm going to give you an overview of each of these kind of themes, and then share with you some really kind of nerdy charts that we've put together to help you visualize what's happening here in the economy. So we'll start here. The first thing, of course, that we're watching is the measures to contain the virus. And the stringent measures have really helped slow the spread. But the uncomfortable truth right now is that we're in a little bit of a limbo or no man's land. Not sure if any of you have kids, but have any of you ever taken your kids on a long road trip? My grandparents took me on a road trip every year where I was forced to listen to musicals. I know the words to just about every musical out there, but I would still ask them, are we there yet? Are we there yet? Are we finished? And I think that's a little bit collectively of how we're feeling right now. And it's a challenge because it's a little bit too late to crush the disease through intensive testing, but we're still too early for a vaccine or to see the clinical trial results of therapeutics. Also, a complete lockdown to eradicate is really not completely realistic. So I think both personally as well as from, an investing standpoint, I think we have to accept that both our lives and the economy are going to be constrained by this pandemic until at least 2021. The CDC last week released an outline of their phases to return to normalcy. I think it's important to remember that normalcy is going to look a lot different for all of us. It's going to be a different type of normal, right? That we're going to perhaps think twice before we shake hands, that we may not return to large crowds. But I think it's important, we would really look at that more instead of a 3-phase framework of a 5-phase framework. So the first being the strict lockdown phase, second, an adjusted lockdown. You're starting to see this take shape in different parts depending on where the curve is, in places where the number of deaths have decreased or the number of hospitalizations. The third and perhaps most important one is going to be school reopenings and better treatment phase. What will that look like in the fall? Will kids be able to go back to school? Fourth, the vaccine distribution. And lastly, a post-COVID world. What does that look like? So what you're looking at here is the left map is from the University of Oxford. It's a stringency index. Essentially, it's the severity of the response. So it's looking at things such as school closures, travel bans, cancellation of public events. So you can see where the United States compares to places such as Italy, France, Germany, and the US. Now, the graphic on the right is, of course, the active cases per capita. This comes back to kind of flattening the curve, and this is from Johns Hopkins University. And again, different parts of the country are going to experience this at different times. Some places are starting to flattening the curve, while others are still looking for more realistic information. One of the challenges here is that there's no first mover advantage, that places don't necessarily want to be the first to reopen, because if we saw an uptick in cases again, it could set back the economy. So what does this look like? One of the big numbers that came out today is Purchasing Managers Index, or PMI. And this is a really good way to predict what's going on and what's happening in the economy. And activity is no surprise, it's really grounded to a halt. And the rebound will depend on the path of the outbreak, again, the effective delivery of the policy response, and potential changes to consumer behavior. But this is a very good visualization of that phase one, that strict lockdown, which started in mid-March. And essentially what it's showing you is a complete collapse in output. So this is, again, the Purchasing Managers Index. It's a survey of purchasing managers. Perhaps we even have some on the call today. But they're very important individuals. They're the individuals that make the decisions on buying things for businesses, right? Whether they're looking at inventory or they're looking at things such as office desks for employees. And they're looking across manufacturing and the service industry. They really look at 5 different measures, right? They're looking at new orders, inventory levels, production, supplier deliveries, and the employment environment. And they rank, is this going to be higher, the same, or lower? What 50 represents is kind of the baseline. So if the PMI index rises above 50, we would classify that as being in an expansion. Below 50 is going to represent that we're in a contraction. And it's really a very important economic indicator. You may have heard a lot about this in 2018 during the trade tensions, right? And really, we've seen the steepest decline since March of 2009. So this collapse in output in the second quarter would represent, perhaps the biggest recession since the Great Depression. We received data coming out of Europe today on PMI, and the PMIs came in at 13.5, right? So well below that 50 threshold. Recessionary numbers, typically, if you can see on this chart, are usually in the 40s. So this is the weakest level that we've seen on record. And the anticipation of these dismal numbers, we knew that they were coming. We also saw unemployment numbers today, really triggered a very aggressive response from both the Federal Reserve as well as the federal government. So kind of the question is gauging the shock. And I'm going to use this as perhaps another analogy that will help. Not sure, we were talking before this started the call about how we can't wait for salons to open, but some of us are in need of a haircut. Well, my husband was in need of a haircut this week, and we had the conundrum. Do we cut it now and live with the consequences, or do we wait? And I think it's important. We had a very lively conversation, and we decided that a haircut is temporary, that his hair will hopefully grow back despite the damage that I actually unfortunately did to it. I should not quit my day job. And it's similar to think about this in the context of the stock market and the economy as well. You're going to see, and there's going to be damage inflicted. The question is, how quickly can we grow back and what does it look like? So you can see the stock market really hit a low on March 23rd. The S&P 500 was down 34%, and it's rallied since. So again, a recession or a dip in the market is not forever. So one of the things we talk a lot about when we judge the market reaction is, will the recovery be, we use the letters of the alphabet, right? Will it be V-shaped, V as in Victor, meaning it's a steep drawdown and then bounces up? A W, which is perhaps the worst type. We classify these as a double dip, where the markets go down, they recover, and they dip down again. Certainly something that has the potential to happen. Or a U-shaped, right, where you see that we go down, we stall out at the bottom and come back up. But I think what we should really be considering is the overall macro impact of itself. And the question we often get is this a 2008, or how does this compare to the global financial crisis? And really, we don't see this as a financial crisis. It's a crisis of confidence, it's a public health crisis, but it wasn't and didn't originate or start in the markets. So it's a little bit more akin to maybe a natural disaster, black swan event. So what you're looking at, I know these charts are pretty technical, but in 2008, the shock spark was in the financial system, and the impact on real activity was indirect and more uncertain, versus the current shock today is, very directly impacting real activity, very large, and it's very visible, right? We all know that we can't go to the salon, that we're not going out to eat, that events have been canceled. So the main growth consequences of the great financial crisis was not the shock itself, but it was the recession and the propagation of the aftermath. We saw a major decline in activity, and this was caused in large scale by debt deleveraging, right? That many American consumers as well as businesses had to unwind their balance sheets, and this happened over many years. So the chart on the left is the cumulative post-Great Financial Crisis growth shortfall in the US. So it totals about 50% of the pre-crisis GDP level. And again, looking at that, the majority of that came after that initial shock. That's why it was very long and prolonged. This time, the damage itself is going to come very quick. So if you looking at the chart on the right, we estimate the gross shortfall in the United States will be about 15% of 2019 GDP level, and most of it will be immediate. So if you look at the risk response, and when we say risk response, what we're looking at there is we're referring to equities. So equities were down 30 to 40% across the world, similar to the Great Financial Crisis, but in a much more condensed time frame. But in the long term, that macro shock will not be as extreme, assuming that we have containment measures. So kind of understanding, the shock of the GDP shortfall. And this is why this is a little bit unique. It's an example of a supply and demand shock. You go back to Economics 101, you usually get one or the other. So what you're seeing here is on the supply side, as we just talked about, the way things are getting made are almost completely shut down. On the demand side, you're seeing unfortunately, massive job losses, spending loss. We saw jobs numbers came out today with another 4.4 million of newly registered claims. That brings the 5-week total to 26 million, which is approximately 13% of the working population. And this highlights what we already know, right? We are in a recession. Again, it goes back to the shapes of those letters. Is it going to be a V shape where the growth falls and hits the bottom, a W, which represents a double dip, or U-shaped growth? And we really believe that we'll see more of a U-shaped growth, that it's going to drop. We're going to stall out at the bottom, but then you're going to see a surge. And that's because of demand. And there's two ways to look at demand. There's demand destruction versus delayed demand. So delayed demand means that right now you're facing uncertainty, probably personally as well. You may be putting off major purchases such as a washer and a dryer. In fact, it's very challenging in this economy to spend. Or perhaps you had a vacation that you were thinking about taking, and obviously now you can't. When things go back to normal, you're still going to make those purchases. Home purchases are another example. Now, the bigger issue, or one to pay closer attention to, is demand destruction. And this is activity that you don't get back. An example is in Denver, Taco Tuesday is a very, very honored pastime, right? Individuals go out and might get Mexican food at least once a week on Tuesdays. Now, when we move to more of an adjusted lockdown where perhaps we can visit restaurants and dine in restaurants, am I going to eat out and have Taco Tuesday every night of the week to make up for the time that I lost? I mean, I might, but I probably won't. So those are lost evenings out. It's lost spending that we'll never get back. And that really impacts how we're going to get out of this. What we're anticipating is that we're going to see a surge. So either late this year or in 2021, and that goes back to those stages, right? So adjusted lockdown, moving to school opening to vaccine, and that pent-up demand could cause the economy to grow very, very quickly. You could see potential double-digit annual rate of return in the second half of 2021. The employment rate should eventually fall and fall rapidly, not enough to cause a steep increase in wages. And finally, you could see the economy start to recover and the Fed could start de-leveraging their balance sheets. So I'm not going to spend too much time here. This is actually BlackRock. We like to say that we'll bore you to wealth. I think we do very well with our charts. This is actually, get very excited. This is our chart of the week. But the thing that I wanted to highlight is the response to the coronavirus. And we can talk about two responses, right? The Fed and the fiscal response. And really coming into this crisis, the Fed didn't have as many tools to utilize. So all eyes have kind of been on Washington, D.C. And the stimulus package continues to build that bridge during this economic shutdown. So this week, we're likely to see the House vote on an additional $500 billion in stimulus. That brings the total to more than $3 trillion across 4 different phases of the stimulus. So more than 10% of the GDP. Largest stimulus bill that we've ever seen. It really dwarfs the response in 2008. The stimulus package is going to increase the payroll protection program by nearly double. It's going to keep employees on payroll, limiting the amount of people to file for unemployment to kind of, want to take away that dislocation. And the next package will be released to the healthcare system. So if you look at the initial funding in March was about $100 billion, which was topped off with an additional $75 billion. And this is really to ensure that it has the right resources to fight. And this is combined with the Fed's whatever it takes policy approach. So if you look at it, they've used their balance sheet to stabilize the markets and support the economy in a very meaningful way. In fact, they've increased the size of their balance sheet by 50% more. So $6 trillion worth of asset purchases. That's $6 trillion of money going back into the economy. And this is really key to supporting that payroll protection and the Main Street lending. So the Fed's balance sheet could really climb very sharply. You're looking to about 11 trillion by the end of the year. But more importantly, it's been a very coordinated policy response. So not just here in the US, but abroad as well. So you're seeing Australia, Canada, the UK, we had a surprise cut by the Bank of England. And really, this is the largest peacetime relief program ever. And the Fed's really focusing, again, on liquidity. And that's really what BlackRock was looking for, is again, that we wanted the most important thing to watch besides the human toll and the cost of lives was really the response of policymakers, that it needed to be big and it needed to be coordinated, which is what we see. I've gone a little bit over on my time, so I'll start wrapping it up here. I think it's important to remember that this is what risk feels like, that risk is the source of returns. Volatility doesn't equal loss unless you sell, but that we still are going to experience some bumps along the way. So again, 3 things that we're looking for: the visibility on the ultimate scale of the coronavirus outbreak and evidence that the infection rate has peaked. We're starting to see this. Secondly, the deployment of credible and coordinated policy packages. We've seen this, again, not just here in the US, but around the globe. Again, the largest peacetime measures that we've ever seen, which is pretty incredible. And we don't believe that we've seen the last of it. Lastly, confidence that the markets are functioning, which you're starting to see as well, that overall the financial plumbing has held up. And we believe that the market will reward companies with good management, with strong balance sheets, that earnings really do determine the value of stocks. We're in the midst of earnings season now, and that valuations matter. For those who can, now presents an opportunity that we hadn't seen in the last several months. And really, I'll end on a little bit of an optimistic quote. I think it's, these are certainly challenging times. These are unprecedented. We've never lived or experienced through anything like this. And I think it's very easy to be overwhelmed. And I think it's important to remember that every generation has really faced their share of challenges. And I don't know if any of you can remember what October of 2018 felt like. I know that I had started in the financial services industry. Lehman Brothers had failed. But again, we were starting to see that unwinding of debt, and it felt very bleak. And there was a fantastic op-ed in the New York Times that said, "Buy American I Am," by a gentleman named Warren Buffett. And I think this quote sums it up. In the 20th century, the United States endured 2 world wars, the Depression, a dozen or so recessions, and financial panics, oil shocks, a flu epidemic, and the resignation of a disgraced president. Yet the Dow rose from 66 to over 11,497. So again, certainly doesn't feel good. There's a lot of uncertainty. There's things that we might not know, but it pays to have a long-term perspective. So thank you again for your time. I'm happy to answer questions. I know I went a little long.
Sorry, I was muted. Thank you, Sarah. That was awesome. Does anybody have any questions? If you have questions, you can either unmute yourselves or you can type into the chat.
Pauline? I see.
There is a question from Christina. Amy can read them. You're gonna.
Yeah. So Christina, I'll give you a call and we can chat offline on that, because I know we were emailing as well. So yeah, let's talk about that.
Yeah, I didn't know if that was impacting other people as well.
Well, I mean, it really just depends, you know, on the overall household situation too, you know, because as Sarah was saying, you know, there's opportunities, so we don't want to stop contributing right now, but it depends on, you know, where the job security is, what the cash reserves are, all of those things. So yeah, let's connect.
Yeah.
That's a really good question. So the question from Dave.
Any other? Oh, here we go.
Yeah, here's a good one. The question is about inflation. And right now, so these are all really both the response from the Fed as well as from the government. They are looking, their response would naturally increase inflation. So the worst case scenario that we could have is a deflationary pressure. So kind of the hope is, again, that we have that U-shaped recovery. It's very steep, it's very fast. Not so much that it'll probably cause things like wage inflation, but the Fed would have tools to address inflation if we saw it in a meaningful way. But that's absolutely what they're shooting for. It's a fantastic question. Again, we might see that at the end of this year or in 2021, depending again on the virus and our response to it.
Turn on my camera here. So hi, this is Eric Sonberg.
Hi.
I didn't know we were going to be live, so I apologize for my attire. But question in regards to housing specifically, I know you deal with the stock market side of the world, but how do you see people viewing housing right now? Because on the inside, I see it as things are kind of, as best we can, business as usual. Homes are selling for people that are engaging. The amount of homes shrank in the market, but it's similar to like what I call a holiday effect, when people still need to sell their homes, but there's others that leave the market and then they come back first of the year kind of thing. And that's kind of what we saw. People left but some stayed and are engaging and are buying really great homes and not at a discount. So how do you see that factoring in, or what do you see from your side of the world?
Yeah, you know, that's a really, I think I lost you guys. I'm sorry.
We hear you.
Can you guys still see me?
We hear you.
Okay, well, at least you can
frozen.
still hear me. I'm probably frozen in a really embarrassing manner too.
No, you look good. You look good.
You look fine.
Yeah, I think that goes a little bit back to that demand thing and demand question, right? The destruction or putting off larger purchases. And I think what you're going to see is, even with the recent market dislocation, real estate really continues to exhibit very attractive portfolio characteristics, right? There's a low correlation to public markets. There's portfolio resiliency, consistent income. And there definitely has been a significant drop in deal activity. It's slowed, but we think that a lot of that is just delayed, that individuals are, if they still have the means, are going to buy homes. You're not going to stop purchasing homes. In fact, we just had here in Colorado, they're starting to relax some of our restrictions. And one of the things that they opened up immediately is the ability to not have open houses, but to show homes. So really, you know, there's a lot of questions, and I think the real estate market is a little bit different. It depends on if you're looking at REITs, if you're talking about rent relief from tenants. But our forecast for property valuations is, if you look at the cap rate spreads to the 10-year treasury, are very wide to historical standards. And while there's elevated economic concerns for the market, the spread really should provide a level of support for real estate valuations and a really attractive opportunity for individuals to buy or refinance houses at an attractive point. So I think you're going to see a lot of individuals taking advantage of market dislocation, that lower rates are usually very accommodative to that market. So again, it's not that destruction, that lost activity, that really you're going to see more of a pent-up demand. Does that answer your question?
Yes, very helpful. Thank you.
On that note, on behalf of the San Mateo Area Chamber of Commerce, I want to thank you for attending this Business Essentials meeting. Pauline, would you like to tell them about some upcoming programs?
We have several programs lined up for next week. Business Essentials on Tuesday is from Dr. Larry Feinstein, Lower My Anxiety, Calming During the Coronavirus Situation. And then on Wednesday, we actually have a big town hall meeting with Rakuten. They're rolling out a new takeout app for San Mateo. So it'll benefit the restaurant owners, and also consumers will be receiving a 20% cash back. And then on Thursday for Business Essentials, we have Aaron Sinclair, Stock Market Swings Making You Uneasy. So a lot of information coming at you next week.
So have a great day, everyone, and
Thank you. Thank you, Sarah, again, and thank you, Chad, for helping to set this up. And if any of you guys want to talk more offline, just let me know. Give us a call at the office. We'll get it set up. And
Thank you, Sarah. Thank you, Amy.
Thank you, everybody.
Thank you, everyone.
Yes,
Be safe.
thanks for having this. It's great. Thank you.
Have a great day.